Okay, so I'm going to go into the simplest form of option selling, credit spreads, iron condor that you could possibly get. If you look it up online, it's going to be a lot of kind of bullshit, to be honest. Stuff you really don't need to know about. So I'm going to try to simplify it as easy as possible. First, I'm just going to go over what you actually need for the account for to actually trade spreads. So first off, it could be any broker. I have Robinhood up here because I know a lot of people use Robinhood. Just going to make it easy when I actually, show you how to execute a trade on here. But you need a margin account and you need level 3 options for any broker that you use. So margin account and level 3 options. That's to even start trading spreads, being put spreads, call spreads, iron condors. Now, we'll get into this later on a little bit, but you could sell puts or sell covered calls if you have 100 shares of a stock. That you only need level 2, but we're fully diving into actually selling spreads and put spreads, call spreads, iron condors. Again, margin and level 3 options trading to do so. What we're going to do now is basically go over a put spread. A put spread is actually a bullish trade. So you want, in this case, I have Qs. I trade Qs a lot. I trade NDX a lot. In this case, you want Qs to stay above a certain price to make profit. That is what a put spread is meant for. And you're going to be collecting premium. You want the sold strike, the stock price or the index price in this case, to stay above that sold strike to collect full premium. So let's kind of dive into an example of a put spread here. I sold a 622 put and I bought a 621 put. We're obviously using just December 30th expiration for the example. You get 23 cents of credit. So for every, I'll make $23 for every contract I buy. Now, because I'm selling a 622 and buying a 621, there's a $1 strike difference in between that. Obviously, what that basically means is you'll need $100 in collateral per contract you open, per spread you open here. So if I do one contract, I need $100 to open that trade, and then I'm expected to make $23. So that's a 23% return on that.
So if you want 10 contracts, you need $1,000 to be able to cover that.
Okay. Yep, $1,000 to open 10 of these contracts. And in that case, you can make a max profit of 230 because you just timed this by 10.
Because you're looking for those contracts, just for the audience here, to go from 23 to 0. Right?
Correct.
It's the opposite. See, and that's something that I kind of couldn't wrap my mind around at first, but you're wanting your contracts to go to 0 because you're on the opposite side of the trade of what you usually would be, right? Traditionally, we're trying to buy an option at a low premium and have it go up, right? And sell it at a higher premium, where as this, you're essentially shorting the premium, and that's what I got. It's very similar to kind of shorting stock in a way, because you're looking for that premium to go to 0, right? And that's how you're making your money. So
now that we basically did a put spread, and if anyone has any questions on that, always feel free to ask. We're going to do a call side. So in a call side, you want, again, same type of thing. You're going to be selling a strike and buying a strike, and that's how you get your premium difference there to make money. Now we're going to sell, let's just say, a 627 call. So we want Qs to stay under 627 by the expiration to make profit. And then I'm going to buy, this time I'm going to buy $2 out. So we're going to buy a 629 call. So on this one, we're $2 strike wide. So it'll be $200 per contract if you want to open it. Okay. But in this case, we're also making a little bit more premium. Now, if you see, if we did a $1 strike wide, you see we're at that 23 cents again. $2 strike wide, $200 to make 41 cents or $41. So if I wanted 10 contracts now, I would need $2,000. And then if I wanted 10 contracts, I would make $441. So again, great return on that. But I also want to dive in very soon on how I pick my strikes, because I personally wouldn't do it this close. But again, in this case, all you need is for the stock price or the index price of Qs to stay under 627 to make profit. So call spread is bearish, put spread is bullish. Kind of opposite of what you normally think in a directional trade, where you're buying puts, you want it to go down. You're buying calls, you want it to go up. Another thing to kind of note, be notified of here is you can have the stock price. Now, whether you're on a put spread or a call spread, okay? In this case, we're on a call spread, so I'll talk about the call spread side. Share price is 623.20, okay? We sold at 627. Qs can go up to 624. It could go up to 625. And yes, you could be losing money in that case. Your contracts could be going up in value. In this case, you'd be losing money because you want them to go down in value to make, money. But in this case, it's just going to be theta burning. So, it's 2:11 right now, 2:11 p.m. Eastern. If the market was open, we would have an hour and 39 minutes left. If the stock price is at 624 to 625 and we had these open, early in the day, the premium, and we got this at a 41-cent premium, the premiums would probably be about 10 cents.
Yeah, they would be almost worth nothing.
Exactly. Because at this point, we're already theta burning, and we're still over, if we're at 624, we're over $3 away from our sold strike. And that's the one that matters. Again, the only reason I have a lot of people ask this question, the only reason you choose a buy strike, specifically the buy strike side, is where the question comes into place. It's just how far you want to go out more so. So, for example, okay, I sell the 627. You could see if I buy the 628, I'll need $100 in collateral, okay, like we talked about, and you make $23. Now, you buy the 629, you need $200 in collateral, but you make $41. Same thing if you go $3 out, you need $300 in collateral, and now you make $53. So it's more so depending how far out me personally, depending how far out I go in my sold strike, I may need to go further in my buy strike to make more premium. And that's where I'm going to kind of get into, how I choose my strikes. Before we get to that, I just want to do one more explanation. So we have the call side here. I'll keep that same call side. So we're selling the 627 calls and buying the 629 calls. So now we're going to open an iron condor. Okay. So in this case, let's sell a 620 put and buy a 618 put. So now an iron condor is where you basically believe that whatever ticker you're trading is going to basically range trade. If I sell a 627 call and buy a 630 call, that's $3 wide, obviously. And then I sell a 620 put and buy a 618 put, that's $2 wide. The whole entire trade, I'd still actually have to do the $3 wide because I opened one side of that. So I always like it to keep it the same width of strike length on both sides. So in this case, $2 wide. You will only need, by the way, people think, ask this a lot. You will still only need $200 in collateral for the whole entire trade. Just because you opened another side does not mean you need 400 now. It doesn't multiply. You only need 200. So now your credit's even higher. Okay. So $200 per contract to make $67. That is an absolutely phenomenal return. That's over 30% return on that investment. On that investment. But in this case now, you need Qs to stay in between the sold strike of the 620 put, so 620, and the sold strike of 627. Oops, sorry. So for that, again, QQQ, 620 and 627, you want, for an iron condor, you want it to stay in between that price to make profit. So we did a put spread, we did a call spread, we did an iron condor. Now we're basically going to go into how I do the strikes, how I pick the strikes that I want. I am very conservative. I'm looking to compound my account over and over. Yes, you're going to have losses. No matter what, you're going to run into a loss. But I'm looking for compounding. I'm looking to grow my account. So what I personally do, what has worked for me exceptionally over the past 6 years, and again, it's literally a second income for me. So in this case, I'd be looking, and of course, it's not just looking at the delta in general and just saying, oh, okay, I'm going to do put spreads today because of, the delta's really high on this side. No, I'm still looking at the charts. I'm still looking at the trend. And again, I'm going to keep getting into that further on, but I'm just going to go into how I choose my strikes. So I'm going to sell a 616 put here. And in this case, I want to collect some decent premium. I want to get more than 10 cents, So I'm going to go $3 wide. So I'll need $300 per contract, selling a 616 put and buying a 613 put. In this case, let's just say I believe that the market's gonna, push higher. Let's basically go over what happened on Friday. And I saw we had this major drop. I got put spreads, around here. I like to do mean reversion trades with spreads. That has been my bread and butter over the past 6+ years doing this. And of course, again, I would not be 100% every time. And you can see, I'll show you my results, very soon once we get past some of the introductory stuff here. But that mean reversion part of spreads has been absolutely exceptional for me. So I'm selling a 16 put because I thought the market was going to hold up, and I'm going to buy a 613 put as my, collateral difference here. So I'd make $15 per contract with $300 in collateral. So that's a 5% return on investment, $300 for every contract I buy, and I'd make 15. So again, let's just say, the 300 divided by the 15, you'll get 5% return on your investment, which is a great trade. There is nothing wrong with that. Again, especially if you're compounding, that's the whole goal here with spreads trading, when you take that conservative approach. So that's basically that. I'm always looking for 88% plus delta. And that has been something that has been a key for me, has been working exceptionally. And I stick by that 100%. I do a lot of same day expirations for Qs and NDX. Again, in this case, we're doing it on a Saturday, so I won't be able to kind of show you, but you could see the same results here, and you can see the same thing when you're looking at chance of profit. So again, it shows delta there is basically 9 cents. So that's basically a 91% return on 91% chance of profitability. So again, same type of thing. You kind of just look for that. If you don't have the chance of profit on your brokerage, as something like Robinhood does, you just do 1 minus the delta that it shows. So 1 minus 0.09, and you'll get 91%. So another thing I want to go over is we talked about put spreads, call spreads, iron condors, basically how I'm choosing the strikes. Now I want to talk about some rules that I set in place. So me personally, I wait till 10:30 a.m. Eastern, an hour after the market opens, to get all the data out of the way, see if we have a trend in the market, within that hour. And, hopefully in that case, I don't trap myself in entering something too early and, it going against me. So I'm trying to figure out what the trend is for the day, what the market wants to do, digest that data. So 10:30 a.m. Eastern is my first rule. Second rule, 200% stop loss. Now people hear that and they go a little crazy. They're like, why would you risk 200%? I've tested 300%. I've tested 250%. I tested 150%. I found that 200% is that sweet spot. So again, we're doing a strategy that for me is a compounding strategy. In this case, let's just use this as an example. Okay. I buy one contract. I make $15. My stop loss is $30. I'm okay with losing 2 times my premium because I know with the consistency I have on this, where I'm winning 85, in this case, 85% of the time. And you can see here, I'm winning 85% of the time. Look at all the green there. So I'm winning 85% of the time that I know I could withstand a loss and continue to compound and make that loss back within 2 trades at most, and then be in profit on the 3rd trade.
Well, yeah, it's simple, right? It may be a negative risk to reward ratio, but which
Correct.
I'm usually not in favor for, right? But when your win rate is so unbelievably high,
exactly,
it doesn't matter. You're totally willing to show up and say, I'm going to win 100% and I'll risk 200%, no problem. Because that just means, okay, if you take a loss, you lost your past 2 trades. It's essentially what it means.
Yeah.
Of course, if you're sizing somewhat consistently with this, that's all that means, right? And so, of course, traditionally trading, I'm not looking to do that because on the other side, we can get so much more in our favor. It's so easy to get a positive risk to reward, but it's not with spreads. You need to withstand that little bit of drawback, right? And I've found that personally to be perfect as well. I haven't really tested anymore, but I've just been following what you've been doing, Knots, and having that with as high as the win rate is, it's no problem. And even if you do get knocked down on a day, okay, like you lost the past 2 trades that you've taken. So what? Like now you're projected to go on another streak because it's just you've already gotten that loss out the way now.
This was $5,000 to $94,000 in just over a year. Again, that's me sizing aggressively. Where I'm doing one now that is much less aggressive. But again, you can see the results here. You know, obviously, if anyone wants to see a visual, you could see, you know, you're making money. Boom, you get a little haircut. Making money, haircut. You know, I had 3 losses within, or I think 2 losses. No, 3 losses within, you know, 2 weeks. But now I'm back to all-time highs again. So going back to the rules, I wait for an hour after the market open for safety, see what a trend is, you know, what the market is trending. We talked about the 200% stop loss rule. We talked about the 88% probability. That's another part of the rule. Another thing that I do is again, this isn't a crazy one, but I don't trade FOMC for spreads really. It's just too risky. As well as the premiums are usually inflated the whole entire day. That's a simple rule that only happens 10 to 11 times a year, but is something to consider. But rule-wise, that's basically kind of it on that. You know, it's really just 3 rules: the 88% plus probability, 200% stop loss, and waiting that hour. Another kind of tactical rule that has been added that I actually seriously don't think I've lost on in 2 years is when the market gaps up or down over 1%. I'm already so this is the only time where I'd actually break that 10:30 a.m. rule. I usually wait.
This is when we do that because usually premiums are a little too inflated at the beginning when they gap up or gap down that much, right? That makes sense.
So I usually wait about 15 minutes, kind of let it digest a little bit. And hopefully it kind of goes in the direction that I actually want to sell it. So for example, let's just use this as an example. Let's say the market gaps up 1.2%. And, you know, 15 minutes into the market, it goes up another, I don't know, 0.2%. I want to sell a call credit spread because the premiums are going to be jacked because of the gap up and, you know, also that move at the open. So I want to sell a call credit spread. In this case, let's just use this as an example. So this is where one of those examples where I'd like to be a little more safe. So let's say market gapped up, it's at 623, okay? You know, let's say it goes to 624. In this case, I would want to go safer. So I'd sell 630 and I'd buy a 633, you know, and I could collect something like that. And this is the only time I'd break that 10:30 a.m. rule.
When do you decide to close the trade when it is in profit? Well, ideally, right, you're holding these till market close because option contracts expire worthless, right? We're trying to sell 0-day options. So what do we want ideally to happen? Well, we want to hold those until the close, until they're worth nothing, 0, right? So ideally, you're sitting in these all day, but with that, it's not something you're heavily managing throughout the day either, though. I've walked away from my screen plenty of times. Just after you get to a certain point, you know, over 60-70%, I'm like, oh, we're chilling, and then you could just see the premium drain happening in front of your eyes, right? There's definitely opportunities where you might exit early, and I'm sure we'll get into a few of those opportunities and show that. But for the most part, you're not looking to get out of this. You're looking to hold it till the market closes, and it takes you out of the trade.
So let's say we're volatile, okay? Let's say VIX is not 14. Let's say it's 18, 19, 20, or higher than 20. We get 50 to 70%. I'm usually looking to close at least 75% of my position, if not all of it. And that's just being safe because we know the market could easily turn around, you know, and go against our direction. But usually, and especially in a case like this where the VIX is really low, I try to hold it to 0. I try to make that full profit. But if I am in 50+% profit within 15, 20 minutes, I'm just going to close it out and just look to reopen a new contract.
We'll do a little Q&A right now. I know Mamba was wondering, do you guys only do QQQ and NDX? I'm personally right now, like I've been newer to spreads. Knots has been helping me out for the past month now. I've just been doing QQQ personally, but obviously you can do this on SPY, right? You can do this on traditional stock, like individual stocks as well, selling covered calls and stuff if you're having a long-term position or whatever. But we were just mainly focusing on the kind of intraday selling of spreads on QQQ and SPY. But yeah, you're doing NDX a lot, aren't you? When you want to take a little bit more risk.
Yes, I'm doing NDX. I'm doing Qs, but mostly NDX. Yes. Why don't you do SDX? That's a question I get a lot as well. So, they talk about the tax bracket thing or the taxes things for trading SPX. It's the same thing for NDX. That's actually why I trade NDX a lot, because you still get that 60-40 long-term to short-term trading. So yeah, I know Qs, I know NDX a lot better. I know NQ a lot better. I focus on them 24/7. So I just stick to trading NDX and sometimes Qs. With that said, I see another question here. Public brokerage doesn't have stop losses on spreads. The only brokerages I know that do is Schwab, I believe E-Trade, and Interactive Brokers. I may be missing one or two, but Robinhood doesn't have it. Webull doesn't have it. Public doesn't have it. A couple others don't have it. But I know Schwab, E-Trade.
That's where you just manually have to manage things a little bit better. Well, guys, yeah, code 35P on Knots' Discord. You guys save some money there. Well, y'all, I think we're going to wrap it up. Knots, it was a pleasure, brother. Thanks for hopping on, doing that. I know the audience really appreciates that. I appreciate that. Shout out to everybody in the chat. Make sure you're liking and subscribing. We're going to wrap it up, but everybody, enjoy the rest of your Saturday. Enjoy your Sunday. Knots, appreciate you.
Sounds good.
And, yeah, we'll see everybody on Monday. Peace out, y'all.